Good morning, friends and fellow traders. This is Doug Campbell with Right Way Options, coming to you with a morning market preparation video for Friday, March 9th, 2018. Hey, it's Friday, everyone, and I think a lot of folks are looking forward to the weekend. We've had kind of an emotional market roller coaster this week with different things happening, big rises, big falls. And this morning we will top that off with the employment situation number. That employment situation number comes out an hour before the market opens, and it is currently expected to come in somewhere around 205,000, which shows just a tiny increase over last month, which came in at 200,000. We're expecting an unemployment rate of 4%, which suggests, the possibility of wage pressures or inflationary pressures on the market. So I think the market right now is just absolutely in wait and see mode. We're hypersensitive to interest rate increases. And right now futures are relatively flat, just slightly bullish. And right now I have to say that the bulls are kind of have the edge here. We've been seeing, good price response. We held support here and we had that big gap down due to the Cohen resignation, and the bulls defended that. We pushed down yesterday and the bulls came back in and defended that. That was the news around tariffs, moving this market around all over the place. Now, the diamonds here itself is still dealing with that 25,000, that big round number, 25,000, and this resistance level seems at this point to be a barrier that we really are having a hard time breaching. It is possible today that employment situation number report comes out with good numbers showing that inflationary pressures are not there. We could finally pop and start moving higher here. Obviously, that's what I'm hoping for, but I wouldn't hang my hat on it. We are about 390 points away from the diamond's 50-day moving average. So the diamond still has a lot of work to do, and the Dow continues to remain the weakest of the indexes at the moment. Keep in mind, once we break through that 25,000 and we break through that 50-day moving average, we still have this downtrend line to deal with. So we're not out of the woods here yet, but it is encouraging, at least at this moment, to have seen the bulls defending. Now, however, if we get a bad economic report this morning on the, showing inflationary pressures, this market has been hypersensitive to interest rates, and we could quickly see a gap down or a move lower. It's going to be critical, if that occurs, that this uptrend holds and these support levels in here hold as support. If we start giving those up, watch out below. We could easily come all the way back down here testing this level, and that would be basically the 200-day moving average could be the target. So let's that's the worst case scenario. Let's hope that doesn't occur. Okay, let's take a look at the SPY holding up quite well. Managed a positive close yesterday. A real strong rally at the end of the day yesterday came in. If we look at a short-term 15-minute chart, here was the end-of-day run yesterday. So we had this really strong end-of-day move that managed to pop us above the 50-day moving average on the SPY, but only by about a half a point. Looks like they carried it through just a little bit further, right after the market closed, but just barely above there. Now, keep in mind, we still have this downtrend line that we have to deal with, okay? And if that employment situation report comes out good, we could easily pop through there today. Again, if it comes out poorly, watch these levels below, and hopefully they hold as support, okay? take a quick look at the Qs. The QQQ, the strongest index in the market currently. That QQQ rallying back up. I'm going to move my trend line now. I was thinking that we could rally up here and hit this as resistance and pull back, but that has not occurred. We've stayed strong. So there's our current uptrend in the Qs. And the Qs, you know, we do have this potential, you know, a top here, and the possibility of a top here. So we've got to be careful. Now, if we follow the trend, if we believe the trend is accurate, and I think it probably is at the moment, excuse me, if that employment situation number comes out good, we could easily pop through there, creating a brand new record high in the Qs. The question will be, can it hold it as support and continue to show strength to the upside? We'll have to wait and see on that. Again, be careful of any pullback that it holds support levels. IWM breaking through this price resistance level, also breaking above its 50-day moving average. Yesterday, IWM just took a little rest, so it's going to be important here also with the IWM, if we do pull back at all, that we find support right in this area, off this trend, off that 50-day moving average, and off that price action, that we get that positive bounce in that area. So let's keep an eye on that. A really good report could certainly send us higher, and we could be attacking these highs up here in the market. So keep an eye on it. And it's fortunate that, you know, as retail traders, not much we can do about big reports like that other than just wait and be ready to react when the market opens. Let's take a look at the VIX. The VIX held up on this support level yesterday. We tried to dip pretty well, but we ended up holding this support level. There's price support through the VIX right here. Also, that happens to be the 50-day moving average. So we held above that 50-day moving average. I think what we're doing is just waiting on that news today. But a bad report could easily bounce us off of there. And if it happened to break us out of this downtrend line, look out below in the market. If we get a good report and this finally breaks below that 50-day moving average, we could drop back down here to the 200-day moving average. That would be a good thing, bullish thing for the market. Some volatility drop out of the market. Maybe we'll get back to some better trading days if that occurs without so much whip. Let's take a quick peek at T21.22. T21.22 is the 4-week new high, new low ratio. And I look at it on a simple line chart like this. And you can see we have a bearish reversal zone and a bullish reversal zone. And when we reach up into these levels or down into these levels, we tend to reverse. We are up here toward that bearish reversal zone. That doesn't mean we can't go higher, okay? But just keep in mind that we're up here in that area where we're a little bit lightheaded. The air's a little light up here, and at any point in time we could see a little profit taking, some selling come in. So keep that in mind as we go forward. On the economic calendar today, we also, besides the employment situation report, we have Charles Evans, Fed speaker. What's interesting is he's speaking 3 times today, 8:40, 10:45, and 12:45. I guess he has a lot to say today. We have a couple other reports here, you know, the wholesale trade and the Baker Hughes rig count. Those would not be expected to move the market. On the earnings calendar, we had about 75 or so companies reporting earnings today. They're already starting to come through on those earnings reports, and you know, earnings have held up really well this quarter. Earnings have been relatively strong. Everything looking pretty good there for the most part, and I would expect that to continue today. But make sure you're checking against those earnings reports for any new trades that you are thinking about taking, or those that you currently hold, to make sure you're not getting caught in an earnings event unprepared. With that, everyone, I want to wish you all a fantastic day. I hope you enjoy or get something out of this market preparation video every day. If you do, please do me a favor. Please click that subscribe button on YouTube, the follow me button on Facebook, and click those thumbs up buttons and drop me a comment. I really do appreciate it. Everyone, I want to wish you a fantastic day. I hope everyone has an awesome weekend. We'll talk to you all bright and early Monday morning. Everyone, take care.